All right, everybody. Well, welcome everyone to today's webinar on reducing your taxable income through investing in real estate. I know that's from speaking to many of you in the past several weeks. Everyone is keeping and staying pretty busy these days. So I really want to thank everybody for taking time out of your day to join today's webinar. I hope you find it beneficial. We're really excited to have Yonah Weiss as our guest speaker, who's nationally known or internationally known now for his expertise in this area. And we will be, he's going to be sharing his cost segregation and accelerated depreciation secrets with us today. We're extremely thankful for his time. As some of you know, Yonah himself is very busy sharing his knowledge in webinars and presentations, and extremely active on social media as well. And he just told us, we thought he was local this week, but he's in Israel. So really want to thank him for his time today. I know each of you are going to get so much benefit from his presentation, as well as the added opportunity to ask questions live on today's webinar. So we're really excited about that. Before we get started, I want to go over some logistics. Right now, we do have everybody on mute except the presenters. And so if you do have a question, please submit it through the question feature at any time and during the presentation, and we'll have a Q&A session at the end. Yonah has some great content to go through, so we'll address the questions at the end of the session as we have time. And this is a reminder that we will have, today's session is going to be recorded, so you'll get a link to the recording as well. So our agenda today is pretty straightforward. Before we hand off to Yonah, we will go through a very short introduction to Spur Equity, and then really let Yonah present the amazing content that he has prepared for us. You'll have an opportunity again to ask questions live for Yonah and really dive deep into the topic today and get real-time responses directly. And then once we finish up Q&A, we'll wrap up the call. So let's start out with introductions on who we are. Rav, I'll let you introduce yourself first.
Sure, thanks, Param. Hi guys, my name is Rav Singh. I'm the co-founder and principal of Spur Equity. I'm also a licensed commercial real estate broker, earned my CCIM designation about 11 years ago. I'm primarily a hotel broker and an investment broker. I've been doing this for the last 15 years. And while I can find great investments for my clients in the hotel space all over Texas and actually the US, I've focused to put my own money and my own investments in the multifamily space, in the apartment syndication space. I find that this space has the greatest and safest, most recession-resistant asset class in this market in this time right now. Anyway, welcome, and Param, I'm going to give back to you.
Thanks, Rav. So good evening, everyone. My name is Param Singh. I'm the other co-founder and principal of Spur Equity. I'm originally from the East Coast, but I have been in the great city of San Antonio for the last 14, almost 15 years with my wife and 3 children. From a career standpoint, I am a director of a specialized consulting practice in global IT and management consulting firm. I've been managing sales and delivery and pipeline of that part of the business for over 12 plus years now, working in management consulting over 20 years. And then from an investment standpoint, Rav and I each individually started investing in real estate over 15 plus years ago in a variety of different sectors, including single family, small multifamily, commercial retail. But then 4 years ago, we decided to join forces and start focusing mainly on multifamily investments. And as Rav mentioned, it is one of the, we found it's one of the safest and most recession-resistant asset classes. So, with the success of, doing that as independent rental owners, we're now focusing on larger multifamily syndication projects. So we can help our investor network grow their wealth in the same way that we've been able to do that in the area of multifamily real estate. And so now we've owned and managed over 750 units in the Texas and Florida markets. So a little bit more, a bit more detail on what we focus on. Again, as I mentioned in our introduction, we primarily focus on multifamily, but even it's one of the safest investment classes. And even what we found is the current situation with COVID-19, where you've seen it yourself, hospitality, hotels, and retail have been hit extremely hard. Multifamily still manages to thrive. So. Oh, sorry. So we try to focus on short to midterm holds. We're not really looking at focusing on long-term hold assets right now because our focus is growing wealth. So short to midterm, 3 to 5 years seems to be the best model for that. And we don't look for distressed properties, but rather stabilized properties, that are already generating income, generating cash flow from day one. And so we look for opportunities to increase that cash flow, which in turn are going to increase the overall value of the property itself. While we started, with smaller properties, we've seen that focusing on properties that are 100 units or more, as a guideline, gives us maximum efficiency with expenses like payroll and resources and other expenses, and truly lets us, take advantage of economies of scale. And then through this model and proven approach, our goal is to really just maximize the returns for our investors through consistent cash flow disbursements and profits at the ultimate sale of the property. And so just to close out, why do our investors and why do other partners collaborate on deals with us? With Rav's detailed professional real estate experience, our collective investment in experience and expertise really provides a good foundation for a joint investment strategy. And, we have a proven track record for multifamily investments. We've also chosen to, invest in our own smaller properties first and refine and develop a very focused investment model, which then we've taken to our investment partners on larger deals. And through that strategy, we've introduced one of the most effective and efficient models, I think, of wealth growth for our investor network. So, one of the things that we say in the multifamily space is that this is a team sport. You'll hear that term a lot. You'll hear it from me, you'll hear it from Rav. You're only as strong as the team when it comes to multifamily investments. And so this is what drew us more and more into this space. When putting deals together, where you're truly partnering, you're truly collaborating with various partners from property management, your lenders, your lawyers, insurance agents, and cost segregation and tax professionals. So it's through that sort of collaborative environment that Rav and I got this opportunity to learn from others that know more than us and increase our own knowledge. And since we've benefited from that ourselves, our team, both values wealth growth as well as knowledge growth. And we love partnering with partners that have that same belief, which is why, today we're really, really excited to have Yonah with us so he can share his knowledge, his skills and expertise with us today. So I'm going to let Rav give a quick introduction to Yonah, and then we'll hand over the rest of the presentation to him. Rav?
All right. Yeah, sounds good. Thank you. So I'm pleased to introduce Yonah Weiss on our webinar tonight. Yonah is a powerhouse with property owners' tax savings. As a business director at Madison Specs, a national cost segregation leader, he has assisted clients in savings tens of millions of dollars on taxes through cost segregation. His background is in teaching, and he has a real passion for real estate and helping others. He's a real estate investor and host of the new podcast, Weiss Advice. I've been following you, Yonah, for the last few months, especially on LinkedIn, and really love your passion and drive to connect people selflessly to their mission. He's a real estate investor, as I said, and he's a host of new podcast called Weiss Advice, which I believe takes a different perspective, dives deeper into people's big why. So definitely check out Yonah's podcast as he brings outstanding guests over there. So today, with great respect, I'm just going to turn it over to you, Yonah. Hopefully you'll give great expertly advice and really answer people's questions on, what is cost segregation and the benefits, what people can achieve from it. So with that said, floor is yours.
Thank you very much, Rob. It's really gives me a pleasure to be joining you guys tonight. I really appreciate the invitation. You guys have a great crowd here, and I hope I'm able to share a little bit about myself and about cost segregation in general. And specifically, I understand there are a lot of people, different various backgrounds in this call tonight. So I hope we can cover the basics of this really kind of intricate, but I'm going to try to break it down as simple as possible so that we can all understand it. And I think, as you said, Rav, my background in teaching, I think I've had the experience, especially in working in the cost segregation industry for a number of years, that ability to kind of break down this complicated topic into a pretty simple way for everyone to understand, right? You don't need to have a tax background, engineering background to do this. You can do it, you can understand it based on any level that you're on.
Great.
So with that being said, I'll just get right into what we're going to talk about tonight. And I understand cost segregation is for any type of property, but really what it is just an advanced form of depreciation. So we're going to get into what is depreciation. It sounds like something negative, but we'll clear that up. We'll talk about the benefits, who this is for, who should be doing it, when you should be doing it, what's bonus depreciation. This is something new. People think it's something different. It's not really. We'll clarify all of that. And most importantly, we'll talk about what's a real estate professional, because that's a really, really important thing. Although you don't need to have that status, which is an IRS status, to gain the benefits, although it's going to be extremely compounded if you do have that real estate professional status, as we'll see shortly. And then we'll do a short case study so you can take away with you, what does this mean in terms of numbers, okay? But I'd love to break it down just from the beginning, the basics. So we'll start with depreciation, okay? And as I said, cost segregation, the name, just take the name. It means we're segregating the cost of a building. We're breaking down the cost of a building into different categories. So let's just talk about depreciation for a second. It's based on the principle, okay? And depreciation is a tax deduction that the IRS gives you if you buy a property, if you own a property, excluding your personal residence. However, any investment property or business property can get depreciation deductions. What this is the IRS says you take that purchase price, whatever you bought the building for, you subtract a certain amount for land. Land does not depreciate. However, the remaining amount you can now take as a tax write-off. It doesn't mean that the property is actually going down in value. It's really a borrowed term. And this is really important. Depreciation, it's really a good thing. It's a borrowed term. It's not that your property is going down in value. It's that the IRS gives you a tax deduction based on the principle that things are going down in value as time goes on. Okay, so over a 39-year period, all commercial properties, you can take that deduction. So you take that amount divided by 39. Residential, including multifamily, is on a shorter schedule, 27.5 years, which allows you to take more of those tax deductions, however, over a shorter period of time, 27 years. Cost segregation essentially says that there are many different components in a property that actually depreciate at a faster rate. And this is also based on the principle that things, like a carpet, you're going to replace every 5-10 years, right? The furniture or different things, they depreciate on a shorter lifespan because they have a shorter useful life. And if I'm talking too fast at any point, please ask the questions, stop me. We'll love to get to those questions at the end. There are certain assets within a property, and we'll get to a list in a couple slides from now, that depreciate on a 5-year schedule and a 15-year, 7-year schedule, which means you can take the value of those assets, of those components, at a faster rate. That translates into bigger tax deductions up front during the earlier years of ownership, which translates into less taxable liability, more cash flow, simply put. Okay, so it's a great tool. It's a tax planning strategy that a lot of people are using. I mean, this is not something, some weird strategy. This is defined by, created by, and governed by the IRS. All the rules are in there in the tax code. It's just something that it requires an engineering component to it. So we'll get to that in a minute, why this has. So let's just take one step further just to understand depreciation. let's say you buy a building for $1 million. You obviously have to, like I said, subtract a certain amount for land. 15% is pretty average. It's actually the national average, although it will depend on the type of property, size of property, location of property. Certain areas, California, for example, is notorious for having very high land values, maybe up to 40, 50, 60% land value. The remaining amount is going to be what you can depreciate, how much of that you can take as a tax deduction, okay? Now, what's the tax deduction? It means you lower your taxable liability. That's it. You make a certain amount of money, you can subtract from that with the deduction and only pay tax on the remaining amount if there is anything left. So in this case, $1 million property, your depreciable basis, the amount you can write off, is $850,000. You do that over a 39-year period. That means every single year you can take a $21,000 deduction, okay, over residential. And again, that's commercial properties. Residential, including multifamily, it's 27.5 year. That's a $30,909 deduction. That means every single year that's your tax deduction. So if you're making your net operating income from the property, your rental income is, let's say, $50,000, $60,000, that means you immediately subtract that $30,000 from it and you're only paying taxes on the remaining amount. Simply put, that's depreciation. It's a great benefit, great tax benefit for investing in real estate. However, there is, with cost segregation, you can literally double or triple that tax deduction during those earlier years of ownership. Okay, and we're going to get to the details of how that works out. So think about it that way. If you're making $50,000 and your normal depreciation is only $30,000, you still have to pay tax on the remaining 20. What happens if you have more deductions? You have a $60,000, $70,000, $80,000 tax deduction, and you're only making $60,000. You're left with what's called a paper loss, a negative income. It doesn't mean that you're not making money. In fact, you're making all that money and the cash flow is staying with you and you're not paying taxes on it. So you'll get your K-1 tax form that will show a negative. It just means that you are not paying taxes on that and you have a balance to carry over to future years. And we'll get to more of these details as we go on. So let me talk about some of the fundamentals and why your tax advisor or your accountant may not have told you about this, even though up until this point, we're talking about taxes, right? We're talking about depreciation, it's a tax deduction. However, cost segregation is an engineering-based study, okay? This is something that needs to be done from an engineer. So most accounting firms don't have engineers on staff, and so therefore they're not qualified or capable to do a cost segregation study. Don't get me wrong, there are certain accounting firms that do. In fact, the Big Four, the largest national accounting firms, Big 10, they all have engineers on staff and do cost segregation in-house because it's worth it for their, multi-million-dollar, billion-dollar clientele who own, large corporations and large properties to do it in-house. However, 99% of accountants out there do not do cost segregation in-house. And believe it or not, if they are not real estate focused accountants, they may not even know that this exists. It's possible. The tax code is huge. And so that's why we're here tonight. We're learning about this strategy. This applies, like I said, not just for real estate investors per se, but even business owners who own their property that their business functions out of. And so that's really important too. We'll talk about every type of property, not just multifamily, everything whatsoever. So what we do with the engineer is required to go to the property. Now we're actually doing a lot of these smart tours, we're calling them. So we're doing it virtually. Our engineers on staff are just virtually viewing the properties with someone on site, taking them around with the video measurements, et cetera. But they need to go in, identify everything in the property, walk the entire perimeter, every unit, everything inside. We're going to identify those things in the tax code that have shorter depreciation lives. Like I said, there are a few categories. Personal property depreciates on a 5-year schedule. We'll get to that. Once you do that, you can now tally that up, create a calculation and know how much tax deduction you can take up front, creating a new depreciation schedule, like I said, allowing you to take those bigger tax deductions up front. And so here is a sample of a couple of, this is from a multifamily property. And like I said, commercial properties are going to be different things, but these are samples of things that are in a multifamily property that depreciate on faster rates that our engineers are going in, identifying how much of them there are. What's the value of each, assigning a value based on industry standard values and construction standard values and local values of these things. For example, 5-year property means all of these things, when we're identifying them, furniture, equipment, appliances, right? Even things that you don't think of, but anything think about anything in your property that's not part of the structure, even if it's attached, carpeting could be attached, but it's not considered structural. You know, cabinets and countertops can be attached, but they're not structural. All of these things have a 5-year depreciation life. Identifying the value of them can produce sometimes upwards of 20–30% of your property value in these assets, okay, which is huge. 15-year property. So these, again, these two main categories. Number one, 5-year property. Number two, 15-year property. 5-year property is that personal tangible property, anything in the building that's not structural. 15-year property is anything outside of your property, land improvements. So not land, remember land does not depreciate, but anything on top of the land, like landscaping or pavement, concrete. If you have any type of retaining walls or fencing or signage, all of that stuff has value to it. And we are identifying what the value of that is, taking that at a faster depreciation rate. Okay, so these are the main things that are going in, identifying, and again, in commercial properties, there's going to be different things. In a retail property, there's going to be things like you know, refrigeration. You're going to have things like different types of special purpose lighting. You're going to have in self-storage facilities, you're going to have climate control systems. These things all depreciate on a faster rate and have a lot of value to them. So just to show you what the typical reallocation, and I mentioned 20–30%, here, this chart will show you based on what type of property it is, what our averages are. And we're, like I said, we're the largest national company doing this. We've done upwards of 15,000 properties across all 50 states. So we have a lot of experience in all these property types. Apartment buildings, like I said, typically between 20 and 30%, 25 and 30%. Other types of properties will have more. Grocery stores, retail properties, hotels, upwards of 35% of reallocation to these faster lives, okay? What that's gonna do is produce huge, you know, tax deductions in those earlier years. And you'll see the second to last one over here is mobile home parks, MHPs. Those are off the charts because there's something really unique about mobile home parks, which is part of the reason why it's become much more popular over the past couple of years, is because typically when you don't actually own those homes, all you have is the concrete slabs, okay? You own the landscaping. What that does is basically all you own is the land and the land improvements. And so the land improvements, as I mentioned in the previous slide, depreciate on a 15-year schedule. You can accelerate 50, 60, 70, even upwards of 80% sometimes of the purchase price into those 15-year assets. So we're accelerating a huge amount of that. And as we'll get to shortly, there's something called bonus depreciation, which makes it so much better. Okay, and as you can see, warehouses, for example, at the bottom, they have a lot less because if you think about what's in a warehouse, there's really not a lot there. Usually the only thing that's going to be is maybe some shelving, maybe some special purpose lighting, security systems, things like that, where those values are depreciated on a faster schedule. So just to recap, what we're doing is we're reclassifying assets in a property to faster depreciation schedules. This is creating bigger tax deductions, reducing our taxable liability, hopefully to zero, right? That's really the goal over here, right? Make money and not pay taxes on it legally. This is really so it's increasing your cash flow. The more money you have, the more you can reinvest that money. And really more than anything, this is the time value of money, because time value of money means $1 today is worth more than $1 5 years from now. Okay, so yes, we're not creating deductions out of thin air, but what we're doing is we're taking a 39-year potential tax deduction and we're front loading a large portion of that to take now so that you can use that. So the time value of money is what can you do with that money? If you had $50,000 today, would you invest that? What would you do with that money? Would you let it sit in a bank and do nothing? Or would you rather just get, you know, $5,000 of that over the next 10 years? What can you do with that? Much less. Okay, so that's really the point of this. It's the time value of money, not just because inflation is 2 to 3% a year. And so anyways, you're getting return on your money just by having it, but also because you may not be holding a property for 39 years. So to take advantage of those tax deductions when you're able to, it's an incredible thing. And I'll paraphrase here. There's a great book. I'll plug Tom Wheelwright, Rich Dad Advisors. I don't know if anyone's a fan of the Rich Dad, Poor Dad, but Tom Wheelwright wrote a book called Tax-Free Wealth. And in there, he talks about depreciation. He talks about the advantage of it, and specifically cost segregation. He says that why aren't people doing this? Basically because they're either ignorant or lazy or both. And it's to no fault of our own if we don't know about something, but it's really to the fault of accountants that aren't proactively telling us about these tax deductions. And this, like I said, this can apply to anyone, not just a real estate investor, whether you're a passive investor or whether you're an active investor, which we'll get to shortly. But even if you're a business owner and you own a property that your business functions out of, for example, a doctor may own the building that they practice out of. A manufacturer may own the warehouse or the facility that they manufacture out of. Those properties get depreciation deductions and are eligible for cost segregation. It's a great way for the business to also get huge extra tax deductions. So this is something that really can apply across the board. Besides for your personal residence, again, any other type of property this can apply to, whether single family, whether multifamily, whether anything. So who should be doing this? This is the question. Oh, is it for me? Is it for anyone? I just mentioned that this can apply to any type of property, but what about you as an individual? How will this affect you? So it affects you individually because any type, no matter what type of corporation or LLC or entity owns the property, it flows through to you one way or the other as an individual. So as long as you are taxable, if you're not a nonprofit, if you're not functioning as a government or educational institution, or you're investing from a retirement account, for example, that might be not tax liable. So anything besides those things, you are able to take these tax deductions of depreciation and therefore get more depreciation. And as I mentioned before, getting more deductions than you have income may be advantageous because you can actually carry that forward to future years. And as we'll see shortly, as a real estate professional, you can actually use that in the current year to offset other income as well. So as an LLC, let's say you're investing in a partnership, in a syndication, and you're a passive investor, usually you get a percentage of ownership of that property. And so your equity percentage, you get also a percentage of that depreciation deduction. So let's say you put in $100,000 into a syndication, and with that, you get 5% of the property. With that, you're going to get 5% of the overall depreciation per year, which means you'll have usually enough to knock off your returns on investment that year. And so it's a pretty good investment strategy because there's almost no other investment vehicle that I know of that you can not only get the return on investment, but you're getting it tax-free. Okay, so this is something big. Again, it's not tax-free forever, but it is for a short period of time, 3 to 5 years, it's going to be tax-free. And that's really important because, again, what you can do with that money, what you can reinvest that with. So let's jump right into the real estate professional, because this is something that is not specifically related to cost segregation, but it applies very much to what the outcome is going to be. And who can benefit from this the most is someone called a real estate professional. This is a tax term. This page is taken directly with the change of formatting, but directly word for word from the IRS, from the tax code. And it defines someone who is a real estate professional means that they have to have 2 qualifications. Either you or your spouse qualifies for this and it's enough, but you have to have both of these. One, you have to have more than 50% of your time is spent materially participating in the real estate trader business, okay? Which means you have to be full-time in real estate. And the second column is going to tell you what those activities are, but you also have to have 750 hours per year, which is not a lot if that's your full-time job. Okay, it's about 15, 16 hours a week. However, you need to be full-time in doing that. If you have a W-2 job, you can't also qualify. Basically, it's impossible to also qualify as a real estate professional. However, one spouse needs to qualify, and that's it. Why is this so important? We'll see in the next slide. But let's define this. If you spend the majority of your time, your business time, developing, redeveloping, constructing, reconstructing, acquiring. Okay, so that could be if you're buying properties, the time spent traveling to that, etc. Converting it, that could be the time spent with municipalities or in the planning stages, things like that. Renting, leasing, operating, managing, or brokering. And this is the biggest one. If you're a real estate broker, you are a real estate professional if you're spending that majority of your time, which means if you also own rental properties, this is where this is going to blow up your whole strategy to be incredibly beneficial. Okay, I mentioned before that the depreciation deductions offset your rental property income. Okay, so let me just clarify that. Rental property income is considered by the IRS, Schedule E, it's considered passive income. Passive income is, it's coming from your rental properties. depreciation is considered a passive deduction, which means it is used to offset, first and foremost, your rental property income. If you are not a real estate professional, you are limited that any extra deductions you have beyond your rental property income, and it can apply to multiple properties. So if you have rental property income from 10 properties, this depreciation can apply across all of them. However, any extra deductions you have, stop there, okay? They create what's called a passive loss, and you are limited to what you can use that passive loss for. If you're not a real estate professional, it stops there. It gets carried forward. You get to use it in future years. However, and this is where this is probably the most important thing. If you get anything out of this presentation, it's this next line. If you are a real estate professional, you no longer, and you qualify to these qualifications here, you no longer have that passive loss limitation, which means any extra deductions you have from cost segregation beyond your rental property income, you can use those extra deductions to offset any income whatsoever. So if you or your spouse has any active income from any source, you can use that extra deductions to offset that. So let me just illustrate what that means. Let's say you have, well, this is actually one exception to the rule, what's called if you have less than $100,000 of adjusted gross income, then you can use up to $25,000 of that. So that's one slide over here. There's one exception. However, let me illustrate. Let's say you're a real estate broker like Rav, okay? And you're making, millions and millions of dollars, right? Like Rav in real estate, in all the transactions, right? You're doing transactions and you're making a lot of money, but guess what? All that money is taxed at the highest possible rate because that is active activity income. Let's say you are a fix and flipper. Let's say you're doing wholesaling. Let's say you're a broker and your spouse is a doctor or a lawyer or a high-paid IT professional, whatever that is. You're getting taxed through the roof, right? Now, comes cost segregation and says you bought a property for, I don't know, let's say $5 million, okay? Put a $1 million down payment and you bought this property $5 million. You now get what's called bonus depreciation. You can get $1 million potentially, just throwing out some round numbers there, of bonus depreciation, of depreciation deductions the first year. Guess what? You're only making about $200,000 from the rental property income from this. However, you can now take the extra $800,000 that you have left over beyond the rental property income and use that to offset your ordinary income. Okay, that's totally like game changing for a lot of people, making sure that they pay little to no taxes. Like the headlines talk about President Trump or Jared Kushner, right, making all this money and not paying any taxes. They're doing it through legal ways that the IRS is giving these rules like cost segregation. Okay, and I will talk about the Taxes and Jobs Act. I want to get too political here to know whether this is going to be repealed or not. Who knows? I'm not even getting into that. I'm just going to assume that right now what we have is as is, and for sure, regardless, will be the case through the end of 2020, no matter what. However, there is something called bonus depreciation. Now, if you remember, with cost segregation, we are identifying property that depreciates at a faster scale, faster schedule. 5-year property, all that personal property. I'll scale back quickly to those slides. Remember all that stuff? Where was it? All the furniture and the equipment and the decorative lighting and all that stuff, okay? It can be 20, 30%. Remember the 15-year property, the land improvements. Remember all that stuff? All of that, once we're identifying that, bonus depreciation says, the tax law says, you have the option now. Once you've identified through a cost segregation study all those different assets that depreciate faster, you can now take 100% of those deductions in the first year. Instead of just spreading, 20% of that over a 5-year period and taking, 20% every single year of that, you can take the entire lump sum in the first year. What that's going to do is going to create a huge tax deduction that first year and likely create what's called a passive loss. So you will be paying little to no taxes. So this right now, as of now, is meant to start to phase out in 2023, which means now is the time to take advantage of it. Whether or not that will change, I'm not going to comment because it's all speculation at this point. There is one other really, really, really important law that came about with the CARES Act a few months back at the beginning of COVID that Congress wanted to try to figure out ways people can get stimulus money. How can we get them more money? So taxes are a huge burden or a huge expense. They came up with this idea called net operating loss carry back. Okay, What this means is that if you paid taxes in the past 5 years, you can now, instead of your passive loss carrying forward, so if you have more deductions than the income, it carries forward whatever's extra you can use in future years. They said you can now carry it backwards. So you can amend previous, and again, this is not so straightforward. It does require extra work. You do have to amend your tax returns to take care of this. But you can go back literally retroactively and take any extra losses you have this year. So let's say you did a cost segregation this year and got an extra $100,000 of depreciation. You can go back, amend up to 5 years back tax returns, apply those losses to previous taxes owed, and literally get a refund check if you have any positive refund from that. So that's a really important thing that came about. Again, not so straightforward. You have to amend your tax return in a special form. You have to file extra work for your accountant. However, this is an opportunity right now for people to find tax refunds. So important to know.
Definitely talk to your CPA.
Yes, talk to your CPA about that. So again, that's called net operating loss carrybacks. When is the best time to do this? And this is a question we get asked all the time. It really depends. And I'll be straight up honest, it really depends, because it may depend on what your situation is, what your business plan is. But I do know for a fact that most people like to get this done in the first year and like to get this done even right away. Not only that, they like to get a free estimate, which is what we provide, even before they buy a property, to see what the potential tax savings are going to be if I do a cost segregation study. So that's something we do, a complimentary service. So if you're under contract or you're thinking of buying a property, you can reach out and get this free estimate, which will tell you what your potential savings will be. However, you can do it really at any point. If you've owned a property for a number of years, you can do what's called a look-back study. This does not actually require any tax amendment or amending tax returns. It's just filing a form to change your depreciation, but you can go back. And this, we see this all the time, people who've owned property for 5 years and they said, well, I never took cost segregation, I never knew about it, or it didn't apply to me, I didn't need those deductions, whatever. You can go back, catch up whatever depreciation you missed that you could have taken, and literally get a big lump sum this year. So it does not need to be done in the first year of ownership. It does not need to be done immediately. However, a lot of people do that because they want to make sure to get those tax deductions in that first year. It also applies to a renovation of a property. And I mentioned at the very beginning that your depreciation basis of any property, how much you can take as a tax deduction, is determined based on your purchase price, and that's it. The only time that changes is if you do a renovation and you add more money into the building. It does not change if you get an appraisal, if you get refinanced and you get a new appraisal and now it's worth more, or the market's saying that, yeah, I bought it for $523,000, but now my neighbor sold his property for $700,000, so now my property is worth that. Doesn't change. Your depreciation tax deduction is based dollar for dollar on how much was spent. Doesn't mean how much money you spent, because you may have gotten a loan from a bank and had the property financed. You may have had owner financing and not even spent a single dime. However, the purchase price is what determines that. So that's a really huge benefit. You get to take the tax deductions of how much money the bank spent. So that's a big thing over here as well. Okay, if you bought a property for $1 million and put nothing down, you can take those tax deductions based as if you spent $1 million. Again, when you do a renovation and you're adding more money into the property, you are spending money. That amount of money is depreciated, and if enough is spent on the right items, it can be cost segregated, and you can apply those findings to get extra, bonus depreciation, or get those tax deductions at a faster rate. So we're just going to jump in. This is basically, we're coming to a close. We're going to end here with the case study here. I know I'm taking up your evening, but I appreciate all of you. I see there are some questions, but we're going to just jump right into some of these multifamily. This is, again, a multifamily property. This, like I said, can apply to anything, but I'm going to tell a little story over here because this is a great story. There's a guy in North Carolina, and he bought this apartment building over here, and he spent $1.75 million on it. Now, it was his first multifamily property. He owned single family properties for a long time, and single family properties don't typically have a lot of benefit when it comes to cost segregation because there's not a high property value, so that reallocation, that percentage is going to be less, and the benefit's going to be less. However, he didn't even know about cost segregation beforehand. That's regardless. But he did know about 1031 exchanges, which I'm sure you've heard of. If you haven't, it's a way to sell a property without having to pay capital gains tax by doing an exchange and exchanging property A for property B and doing it in a special way with special forms and having a qualified intermediary, etc. You're doing it, you don't have to pay capital gains tax. However, he had what's called a failed 1031 exchange. He had a number of single family properties and he wanted to sell them off and do an exchange to avoid the potential capital gains tax, which was going to be about $200,000-$300,000 of how much he actually made from the sale of those properties. And it failed. What it means it failed, you have to jump through some hoops. You have to identify properties and you only have 180 days to close on them, etc. It didn't happen. He lost it. He ended up having the capital gains tax bill. Why am I saying this? Because we're going to see from the Cost Segregation Study, he was able to not only offset his income tax liability, but also the capital gains tax that he thought he would have paid. The extra depreciation actually came and was able to use to offset that as well. So without cost segregation, he would have gotten a regular, remember, straight line depreciation, $54,000, because we're dividing the purchase price, subtracting land, dividing it by 27.5. What we ended up doing was allocating 15% to land, $262,500, and then allocating the property accordingly. And again, this is pretty average, 28% overall, 15-year property, that's the landscaping, the pavement, the concrete, the fencing, all the stuff outside the building, 8% approximately. And again, these percentages are not just random. It's after all is said and done, after a 100-page report is compiled on every detail of every asset and calculations would come up with that. But the numbers, the final numbers are 8% to 15-year property, the 5-year property, all that personal property, right? The appliances and the furniture and the fixtures and the window treatments and all that good stuff. 20%. So we're talking about over $421,000 of extra depreciation he was able to accelerate on a $1.75 million purchase price. That means over 28%. What that translated as that his net operating income from the property was a little over $100,000. He was able to knock that off, not pay any taxes on that income, and the remaining amount he was able to use to knock off the capital gains tax liability that he had. So this is really important that these deductions can be used strategically. Again, this may not be for everyone, but it is a huge tool in your toolbox to use when appropriate. And that's pretty much it. What should you be looking for? This is, you can Google the Cost Segregation Audit Techniques Guide. If this was not entertaining enough for you, that for sure will be. If you want to go to the IRS and read tax code, you can check all that out. But what that does, it shows you that there's a whole nomenclature, the whole numbering system, it's a whole report. And that's why you have to have experts like a cost segregation company like ours to do something like this, not something you can do on your own. You guys already told about us, so I'm not going to tell anything about us before, but happy to take questions at this point. And if anyone wants to find me, you can find me on LinkedIn.
Yeah, Yonah's very active on LinkedIn.
Yeah.
While folks are, I'll remind everybody, if you have a question, please put it in the questions feature on Zoom, and then we'll moderate that. But I want to just reiterate, like, this was mind blowing to me as well. I mean, we've been doing investments, real estate investments for a number of years. Prior to that, single family homes, and then once we get into multifamily, but just understanding cost segregation and bonus depreciation over the last few years, it's just mind-blowing how much of a added benefit, like you said, including in addition to the returns that this property is generating, it's saving, a lot more, right? In some cases, for some individuals, right, from a tax liability standpoint. I mean, in some cases where we've seen these cases, they're saving more on the tax reduction than they are from the returns on the property itself. So it's just mind-blowing, the fact that that we're able to take advantage of it.
Yeah, not only that, I'll just interject one more point over there, which is that I've seen over the course of the years that I've been doing this, literally people who have transitioned from full-time jobs to going into real estate profession and quitting their jobs because the tax benefits of being a real estate professional are better on a few real estate investments than if they literally worked full-time and paying high amount of taxes on their W-2 jobs.
Yeah, no, and we know, Rav and I know, I aspire to do that, but Rav and I know individuals that literally let their CPA will tell them, they'll basically come up with a tax plan to say, okay, you're investing in these, syndication deals, et cetera, but every 3 years you have to buy a property of 1.5 million, and then we can take your tax payment down to zero. So they build it into their strategy to say, well, if I want to save $500,000 in my taxes on, this year, I have to buy 1.5 million. They give them the number that you have to spend at least this much to take your tax liability down to zero. I think that's phenomenal, right? To be able to have, have that number and say, okay, by the end of the year, you have to do this, close on a property personally, or invest this much, and we can take your taxes down to zero.
Yonah, quick question for you while we're moderating the other ones that are coming through. So talk about a mindset of an investor, as an investor. So I buy this property as you're talking about, and I'm going to do the study, and I'm going to take the depreciation and the bonus depreciation. So as an investor, if basically my job is to look at cash flow and look at, how I can maximize, what about after I've done the study, after I've taken the deductions for year 1 or year 2, then what? As most investors out there, you only have 2 things. Either you can keep the property just for the benefits of the fact that I'm going to pay it off, and one day it's going to be for my children. But if you're looking at it from a tax strategy standpoint, technically I see my investors going in and out of properties in the next 3, 4, 5 years because of this reason, the fact that they can restart and they can buy another property and do the study and then take the maximize and then do it again next 3, 4 years. What do you see? To kind of talk about that a little bit from a mindset of an investor.
Absolutely. And I think you brought up an amazing point. And I touched on this before, that someone who's a real estate professional, someone who's investing full time, is going to, get, no doubt about it, going to get much more benefit than someone who's not. And that being said, that also applies to someone who's a more active investor. If you're talking about someone who's just buying one property and sticking with that for the long term, that, cost segregation may not be the right strategy for that person, because having equal depreciation deductions over the course of time may be better for their long-term plan. Absolutely. I find it much more beneficial for people like you mentioned who are active. And when you mean active, like every year, 2, 3 years, they're buying properties, whether it's buying, selling, or just keep acquiring, because with these tax deductions, you can use that to offset income from other properties as well. So it's much more beneficial, like you mentioned, for people who are more active in the space, because they're using that strategy to kind of leverage as many tax deductions as possible.
So we had a few questions, a couple of similar questions came up. I think I answered them, but I'll let you also comment. So a lot of the folks, or some of the folks on the call, are dealing in single family rentals. And so you did mention that this also applies to single family rentals, but in some cases it may not generate the type of deduction that we're looking for, or in the same levels because of the value of the property. But they can take that depreciation early for homes in their portfolio that they have as rentals.
Yeah, so we talked about the percentage of reallocation, and that's really the most important thing over here. If you have, I gave the example of $1 million property. If you have $1 million property, about 20% of that you can get as a faster depreciation over a 5-year period. That means maybe 160 after land, $160,000, $180,000 of extra depreciation. So divide that by 10, you're talking about a $100,000 property, single family. That's about a $18,000 deduction, extra deduction over a 5-year period. It's not a lot. So I think this will segue well into one of the other questions, that how much does it actually cost to get this done? And that's really where this is going to answer this question, because you want to make sure that whatever you're spending to get it done is going to, the benefits are going to far outweigh the cost. And the cost typically for commercial, and we totally charge based on a scope of work involved in it, and typically it's somewhere between $3,000 and $6,000. Most properties fall into that range. Single families, if we're doing a large amount of portfolio together, we can get even cheaper than that. because we're doing a bulk together. So I typically don't like to look at properties, or, I don't recommend, I'm going to say don't like to look at, don't recommend properties purchased for under $500,000 because the benefit is, sure, it's going to be there, but it's going to be a lot less. So would you spend $3,000 to get a $30,000 tax deduction? Some people would, and some people might be worthwhile. Not for everyone though. So that's why it's, it kind of depends on that regard.
Yonah, can you talk about, we have a couple of questions around the real estate professional definition, right? So, someone asked whether they can be a real estate professional if they have a full-time job. If obviously, I think you mentioned it, if both spouses are taking a W-2 income, then it doesn't apply, but only one person has to apply for it to apply, and then they can offset their joint income. And then the second question related to that was, how often do you see IRS and challenging someone that's saying that they're a real estate professional or filing taxes as a real estate professional with that status?
Sure. So yeah, you're absolutely correct on that. Doing one, if you have a W-2 job, every single time that there has been a case in tax court where it's been challenged that someone is trying to claim real estate professional status and also has a full-time W-2 job, it's been overturned. So every single time. There was one occasion that I know in terms of tax law that there was someone who was like an airplane pilot or something that officially had a W-2 job, but they were only really working, tallied up about, 15, 20 hours a week, right? So they were able to spend more time doing that. But generally speaking, it's going to be very difficult. To answer the second, if not impossible, to answer the second part of the question, is this something that raises eyebrows? Is it something that gets more scrutiny? I think it does raise a little more scrutiny. It's not a reason you're not going to get audited. Just to give you some numbers, we've done over 15,000 studies in our company over the past 15 years. And that may be, I don't know how many clients exactly, because many clients have a number of properties, but let's say, make it a simple number, somewhere around, 3,000 to 5,000 clients that we've serviced, okay? In that time, I'm just speaking from our kind of, little bubble. It's not an exact scientific experiment, but of those 3,000 to 5,000 people, we've had 12 of those people audited over that period, past 15 years, that we've had to stand up for our work and support that. So 12, that's a very minuscule percentage. I'm not saying that every single one of those 5,000 were real estate professionals. I imagine likely more than half, if not 70, 80% of them were claiming that status. So I find it I have not seen that to be something that is going to raise eyes for an audit per se, or raise any scrutiny. I have heard from a couple of CPAs that they have had experience. So it could be that there are other things at play, meaning you may be claiming real estate professional status and also trying all kinds of other strategies on top of that are questionable or more aggressive. So I would say it's more about the combination of what's going on and not the real estate professional status per se.
In any case, I guess the guidance is, speak to their CPA, right? And make
Absolutely.
sure that you meet that criteria. Or if you have a strategy that, like you said, there's actually been, you mentioned it, there are folks that have made the analysis and said, look, even if I quit my job and start going towards this direction, I actually end up saving more, right? So there's been people that have made that switch. Just so, or at least one of the spouses has, to be able to qualify, and so so they can reap the tax benefits from that perspective. We have a question about 1031 exchange. I know that's not the topic of today, but could you comment a little bit about that?
Sure, I did mention it in passing, so I will just kind of touch on that. It is a code. 1031 is a section of the Internal Revenue Code that allows for a property to be exchanged on a sale from one property to another. It's a pretty common strategy among real estate investors. It allows you to buy a property without paying capital gains tax. Capital gains tax, combined federal, state, and sometimes even city taxes can be upwards of 25, 30% of how much gain you made on the sale of a property. So this is a great strategy for people to grow, right, their portfolio, grow their business, buy one property, sell it, make money on that sale, and then leverage that money into a new property that gets you much more buying power when you're doing that because you're not paying taxes, etc. So that one thing that does is that defers the capital gains tax. It also defers what's called depreciation recapture tax. Something I didn't touch on too much over here, but there is, when you do sell a property, you are subject to what's called depreciation recapture tax, which means you have to pay a tax on the amount of depreciation that you took. 1031 exchange also further defers that down the road. And whether or not, again, there's been some speculation in the media and, of what might happen in the coming, who knows what's going to happen, if that's going to be tampered with or done away with. It's been around for 80 plus years, and it's been one of probably the main contributors to the real estate economy, I would say, 1031 exchanges. Yeah. And so I highly doubt that it's going to be taken away.
So that's a good segue. So, Yonah, can you, and I know it's speculation at this point with, but, the election and results being fresh on our mind, and with accelerated depreciation and bonus depreciation, do you want to speculate sort of where, where that's going to be headed?
It's really hard to tell. I think, until we have, and I'm going to, be as clear, I try to be as apolitical as possible, but until we have a clear and decided winner, both in the presidential election and in the Congress, we won't know anything. So I'd say kind of hold off. It's definitely good to, make plans and figure out what happens if, you can kind of go down the hypothetical route. I think Biden has not really had any type of tax plan. It's been very, very, very vague. And I think his whole campaign was very vague, what he's going to do, what he's not going to do. So we don't really know. That's the truth. And if there is a Congress that is Republican, then no matter what he wants to do, it's going to be difficult to overturn any things if he can't get a past Congress. So that's my speculation. In terms of that, bonus depreciation is definitely something that is on the ballot. If Trump gets reelected legally, we'll see what ends up happening again. Then he's talking about making that a permanent thing instead of just phasing out in 2023. So that's something to be aware of, but it may be done away with. So definitely time to take advantage of it now would be advantageous.
I think we have one last question, Param, and maybe to paraphrase that question, if there's a couple of partners in a deal itself, and one partner has to sell his shares or something, what happens in regards to, the depreciation in regards to, if I'm getting 50% of it and Param buys my shares, does he now get 100% off the depreciation as a K1, as a negative that he can take, hopefully help him in his taxes?
Yes. So there's something called a 754 adjustment that takes place when you have, not a new acquisition, but a new, change of percentage of ownership. So when you're taking over the equity or you're buying out a partner, there's an adjustment to your amount of ownership. And so therefore, instead of having, 50% ownership, you might have 100% ownership. Therefore, you get 100% of the depreciation going forward based on when that took place. And it's going to go forward based on that amount. So there's an adjustment needs to be made.
Okay, great. Okay, I think you want to do a time check. It's about 8 o'clock. I think
Yeah, I don't think we have any more questions unless I missed it. Oh, let me email. Yeah, no, I encourage, there's some questions around, personal situations and whether they have, sort of property that is worthwhile going through a cost segregation analysis. Yeah, I mean, I think Yonah's made himself available. I mean, you can go to YonahWeiss.com or Madison Specs. He's on LinkedIn, so you can reach out to him directly and really kind of dive into some really specific questions about your situation and get his advice, Weiss advice, right?
There you go.
Yeah.
Podcast.
So yeah, I encourage you guys to do that. Check out his podcast. He's doing webinars with a number of folks out there. So once you get connected to him, you can reach out to him and continue your learning with that as well. So before we close out, I do want to mention that we want to get feedback from the attendees on if these are topics that you want to hear, similar topics around investing and what are the avenues, what are the benefits. We would love to hear from you other topics that we want to bring some experts in. Rav and I don't know everything, and we are so blessed to know folks like Yonah. And so if you have topics that you want to see us bring from an educational perspective, bring speakers, bring experts to the table, please email us at investors@SpurEquity.com or Rav@SpurEquity or Bottom@SpurEquity.com so we can actually arrange additional expert speakers like today. So definitely do that. And I again want to thank Yonah from Rav and myself, as well as all the attendees for taking the time. It's like the middle of the night, early morning for you right now. So I really, really appreciate you taking the time to doing this, and we look forward to additional kind of opportunities for us to get together and learn from each other. That's what this is all about. Great. Well, with that, we'll sign off, and like I said, we'll send the link to the recording to all of the attendees, and we'll look forward to hosting and seeing you guys at the next webinar.
Thank you, Yonah. Appreciate it.
Thank you.
Take care.
Take care. Have a good night. Bye-bye.
Bye.